Want to improve your financial situation but don't have the time for it? Now there's a solution. Watch these financial book summaries anywhere, anytime. It even comes with action steps for Malaysians. What will you discover today? This summary is brought to you by the Financial Roadmap Program. If you know what you want in life but aren't sure if you're on the right path to get there, this is for you. The Financial Roadmap Program will show you where you want to be financially and give you the ways to get there, making your perfect life possible. Sign up today using the link in the description below. There are many books that will claim to teach you how to beat the market. Fail-Safe Investing is not that book. If you're familiar with Harry Brown's work, you'll know that his overall philosophy for life and money tends towards the safe side. That's not to say that you can't still build wealth while being somewhat conservative with your choices. With so much uncertainty in the market in recent years, it pays to adopt Brown's low-maintenance approach to long-term investing. If you're looking for realistic, sensible advice, then the ideas in this book are for you. Here are the 7 fail-safe investing, lifelong financial security in 30 minutes. Takeaway number 1, no one can predict the future. To state the obvious, no one can predict the future. We can make educated guesses based on what's best available information, but the basic truth is that the future is uncertain and anything can change at any moment. Whatever confidence or knowledge we have in the present may not apply tomorrow or next year. By embracing this uncertainty, we can recognize that people who claim to have insights others don't are either deluding themselves or trying to delude us. Beware of financial advisors or fund managers who claim to eliminate risk and uncertainty. That's impossible. Safety comes from preparation for the future, not from trying to get rid of the risks altogether. It's the right preparation that gets you better results and prevents you from making costly mistakes. Takeaway 2. You are your number 1 asset. Don't underestimate yourself and your career as a source of wealth. For one, it's likely that the money you make from your career will be investing capital. That means that for a start, it's wise to develop your skills and career and not just spend all your efforts in investing in the market. Investing in yourself will always provide the highest returns. Use videos like this, books, or training courses to improve your skills, knowledge, and capabilities. This will pay off down the line and for the rest of your life, whether in your career or in the businesses you build. Takeaway 3. Speculation is not the same as investment. Speculation is acting on a predicted outcome at some point in the future. When investors buy stocks hoping that they will beat the market, they're speculating. When you pay roulette at a casino, you're speculating. Investment involves purchasing assets you believe will appreciate in value. Again, no one can predict the future. Ideally, you'd have done your research before purchasing, but even then, there is always the risk that things won't work out. Good investments would have always factored in that risk. Markets adjust constantly to external events to establish prices for goods and services. So in general, it's safe to expect a similar return that the market gets. Speaking of speculation, foolproof speculation systems are a scam. Avoid buying into schemes claiming to grow your money through speculation. If a foolproof system existed, the seller would have no need to sell it to you because they would have already been able to make as much money as they want. Your long-term investment portfolio should, first and foremost, be structured in a way to minimize your risk of loss. Never speculate with funds you need to pay your day-to-day expenses or handle emergencies. Speculate only with money you can afford to lose. Speculating can be fun. But if you do choose to speculate, do so with the knowledge that you're playing with luck. You can gain massively and also lose massively. So never speculate with money you can't afford to lose. Takeaway 4. Make your own financial choices. At some point, you might have chosen to buy the service of a broker, unit trust manager, advisor, and so on. But at the end of the day, whether or not they make any money for you, they are making money themselves. Remember, no one cares as much about your money as that you will. Many have lost their fortunes just because they handed someone else the authority to handle their money. Brokers, fund managers, and advisors will speculate on your money while giving them a percentage of your savings and pay unnecessary transaction fees every year. Ultimately, Brown's advice is to ditch them. If you want to make a good investment return, you have to make every dollar work for you, and you won't be able to do that if you are paying someone else to manage your money. Takeaway number 5. put your money into a permanent portfolio. We know that no one can predict the future, and that it's best if we make our own decisions about money. But how? Brown suggests building up an investment portfolio that is resilient. Your permanent portfolio doesn't assume that the stock market will always be going up, but it's meant to ride out the worst economic conditions over the long term. There are 3 requirements for a permanent portfolio. Requirement 1, safety. You should feel that your wealth is protected. Whether in times of prosperity, inflation, recession, or even deflation, you would be confident in your portfolio. Again, safety comes from making sure you are ready for uncertainty. Requirement 2, stability. Your portfolio performance should not fluctuate wildly when something happens in the economy so that you won't have to pay constant attention to it. Requirement 3, simplicity. Invest in what you understand and keep it simple to manage so that you'll be able to leave it alone for a long time and it won't be tempted to change it. Takeaway number 6. Structure your permanent portfolio according to the 4 major economic conditions. At any given time, the economy goes through different phases and they can be broken down into 4 types. Type 1, prosperity. Prosperity is a period in which the economy is growing, interest rates are declining, businesses are doing well, and unemployment is falling. Type 2, recession. Recession is a period in which money is tighter, businesses are slumping, customers have less cash to spend, and unemployment is rising. Type 3, inflation. Inflation is a period in which the purchasing power of a currency decreases due to increased supply. In general, the reason consumer prices are rising is because of inflation. Type 4, deflation. Deflation is a period in which prices are falling as the purchasing power of a currency increases. This is good news for those with cash, but bad news for those with debt. In the 1930s, deflation triggered the Great Depression due to a collapse in investment purchases. That said, your permanent portfolio should have a 25% allocation across 4 different assets. Asset 1, the Total Stock Market Index. The Total Stock Market Index does well in prosperity. It tends to perform poorly in recession, inflation, and deflation, but this won't matter as much if it's kept over the long term. Asset 2, cash. Cash performs the best in periods of deflation as it gives you purchasing power, while the rise in interest rates increases the return on your dollars. It keeps its value during a recession, but it does not do well during prosperity and inflation. Asset 3, gold. Gold does very well during inflation. In the 1970s, gold rose 20 times over when inflation rose to 15%. However, it does poorly during deflation. Asset 4, long-term government bonds. Long-term government bonds do well during prosperity as well as during deflation, profiting when interest rates fall. However, they perform poorly during times of inflation and recession. Once it's set up, the maintenance is simple. Once a year, check if the value of your 4 investments have stayed within 15 to 35%. If it has gone outside the 15 to 35% range, simply rebalance the portfolio back towards 25%. Another time you may want to check your portfolio is when you notice a big change in investment prices. This asset allocation acts as a system of counterbalancing. For example, when the stock market goes down, gold and bond tends to go up. When gold or bond goes down, the total stock market tends to go up. This means that your permanent portfolio is resilient to any uncertainty and change. By owning all 4 asset classes, you've covered your bases regardless of market fluctuations. A side benefit of this setup is the peace of mind and confidence you can get. You won't be up late at night worrying about your stocks. Takeaway 7. When in doubt, be cautious to avoid costly mistakes. Do what you understand. Otherwise, you could make an expensive investment mistake. When in doubt, listen to your gut, do more research, or talk to a trusted advisor. It's better to be cautious than regret a decision you made later. This is one of the best ways to ensure your lifelong financial security. Be wary of personal debt and leverage. Leverage is essentially borrowing money so that you can multiply your returns. However, while the potential gains are high, so are the potential losses. Leverage can work like rocket fuel, allowing you to soar to crazy heights or explode in mid-air. So as much as possible, avoid getting yourself into big debt. Borrowing money for a new house or car might seem attractive, but it can cause you unnecessary stress down that line. A quick and common way people have gone into bankruptcy is by letting their debts pile up. It's unlikely that you'll go broke by playing it safe. Fail-safe investing recap. Takeaway 1. No one can predict the future. Anyone who claims they can is most likely lying and will actually end up making their money from people who believe them. Takeaway 2. You are your number one asset. Investing in yourself will always provide the highest returns. So take the time to grow yourself, especially when you're under 35. Takeaway 3. Speculation is not the same as investment. Real investors do not buy on rumors that they cannot verify. Takeaway 4. Make your own financial choices. Remember, no one cares as much about your money as you do. Takeaway 5. Put your money into a permanent portfolio. There are 3 requirements for a permanent portfolio: safety, stability, and simplicity. Takeaway 6. Structure your permanent portfolio according to the 4 major economic conditions. The 4 conditions are prosperity, recession, inflation, and deflation. Takeaway 7. When in doubt, be cautious to avoid costly mistakes. Avoid debt, especially if you are using that debt to invest in the stock market. Our thoughts from More Money Malaysia. Fail-safe investing is for those who are more comfortable with a conservative amount of risk. Much of Brown's advice sounds like common sense, but you'll be surprised at how many people get themselves into financial trouble because they don't really understand what they're doing or they listen to the wrong advice. We do agree that one of the best investments you can make is on yourself. And the best way to invest in yourself is by reading or by watching a book summary like this, taking programs to improve your skills. Also, the 4 different assets is an easy thing to do as well. For the total market index, you can buy an ETF that states that it tracks the total market index. For gold, the fastest way to get gold exposure is to buy an ETF that tracks gold, or to use something like Hello Gold to buy yourself gold. For long-term government bonds, once again, you can get the exposure through an ETF. You can also go to your bank and ask to buy some long-term government debt. And finally, with cash, you can just leave it in your bank account. Although we would suggest you put it in a bank like OCBC, as they give you a much higher interest rate. Another idea is to see if a robo-advisor can help structure this. Action steps. Now that you know the main lessons in fail-safe investing, here are the next steps. Step 1. Take some time to determine how you can grow yourself. What professional skills can you take courses and programs on to improve? Step 2. Determine if you would like to follow the advice of Harry Brown and create 4 different types of investment buckets. If so, take the time to find the options you have. If not, we suggest you buy the total market index or use a robo-advisor who will do everything for you at a super low fee.
What did you learn from this video? Tell us below. And make sure you check out all the bonus material that we've created for this summary on our website. The link's in the description below.